Hello, this is Vikas Akhtar, CPA and Certified Tax Advisor in UAE. In this video, we will try to understand the tax implications in terms of a complex group structure. In our case, we have a group structure that have 100% of subsidiaries and operating in different free zones and mainland, while their business activities are also different. For example, subsidiary A, a logistic company, registered in JAFSA. Subsidiary B is a financial consultancy firms registered in DIFC as an investment advisors and fund management services. Subsidiary C is a hotel and hospitality company registered as Ras Al Khaimah mainland. Subsidiary D is a trading company registered in Sharjah Airport International Free Zone, importing goods from China and then storing them and in the free zone and exporting them to GCC and Africa. And then subsidiary E is a software development firm in Abu Dhabi, mainland, providing cloud-based ERP services. So this is our complex group structure. Now, see what will be the VAT and corporate tax implication in this scenario. This is very important to understand a group eligibility in terms of a corporate tax. Corporate tax permitted group eligibility, but in terms of fulfillment of the following conditions: that all entities are resident person. In our case, yes, all entities are resident person. Parent hold at least 95% voting shares of profit rights. That's in our case. Parent is holding 100% of shares. So both conditions are now met. All group members use the same financial years and accounting standards, although not given in our scenario, but we assume that they are following the same financial year and accounting standard. Important point here is subsidiary B may be excluded because of their regulatory nature, because they are operating in financial consultancy activities. Implications: a group is treated as a single taxable person. Intra-group transaction are eliminated from corporate tax purposes. Group must consolidate taxable income and file a single return. Must monitor qualifying income test for free zones entity. Like subsidiary A and D, or they risk losing 0% corporate tax rate. So this point is important, but our topic is not how to manage that risk. We will talk this about later in coming videos. So another implications that the group structures need to be understand is the transfer pricing implication. This because this is a highly risk area for audit purposes. Intercompany services like EPR softwares from E to A or logistic from A to C are subject to arm's length pricing. Very important, Article 34 of the Federal Degree Law 47 of 2022 guide us about the transfer pricing implications. Documentation must include local file, master file, and justification of margin under OECD-based transfer pricing guidance. And failure to price correctly can lead to adjustment and penalties. OECD is the Organization Economic Cooperation Development. They have provided several guidelines on transfer pricing implications. VAT treatment: services from JAFSA designated zone to main zone. Although JAFSA is a designated zone, services do not qualify for zero rate automatically, because as we know that the services are subject to standard rate, although if companies is registered in a mainland or free zone. Most services transactions are subject to VAT at 5% unless exempt, specific international transport. The subsidiary A's logistics services to subsidiary C are standard rate 5% unless they meet zero rating criteria under Article 31 and 32 of Federal Degree Law 8 of 2017. SAF zone trading and export storage is SAF, followed by direct export outside the UAE qualifies for zero rating under Article 45 of VAT degree law, must maintain export documentations such as customs exist report, airweight bills, and customers contract to prove zero rating eligibility. DIFC Financial Consultancy. As we know that DIFC is not a designated zone, but some financial services are VAT exempt. Services to mainland client subject to VAT, standard rate or exempt depending on nature. And services to foreign client outside GCC may qualify for zero rating under Article 31 if certain conditions that the client locations benefit test are met. Risk and structuring complexity. Compliance risk and audit focus area. As we discussed earlier, transfer pricing under corporate tax will be a major audit area. Improper VAT, zero rating claims on export or intercompany services are highly risk. Risk of incorrect tax grouping, especially when free zone companies are involved, and complexity around input VAT recovery from exempt entity like subsidiary B. These are the compliance risk and audit focus areas. What will be the implication? What will be the difference if centralized accounting are adopted or decentralized accounting are adopted? Centralized accounting helps not only to monitor intercompany flows, but also ensure the consistent VAT and corporate tax treatment, manage input VAT reclaim efficiently. While in this case, decentralized may cause inconsistent pricing, double taxation, poor documentation, and VAT recovery issues in exempt activities. So in this complex structure, we recommend centralized accounting. This group requires careful tax planning, especially for maintaining qualifying free zone status, accurate intercompany pricing under transfer pricing, VAT grouping versus individual compliance, and correct zero rating for exports and international services, proper documentations and governance to handle FTA scrutiny. Thank you.